If there's one phrase that's practically synonymous with investing wisdom, it's don't put all your eggs in one basket. That's the essence of diversification, a principle that might sound simple, but it's often overlooked by many traders and investors, especially those who are chasing quick gains or have a favorite stock they swear by. Diversification is about spreading your investments across multiple asset classes to reduce risk and achieve more stable returns. In short, it's your safety net in a market that can be as unpredictable as it is exciting. Let's start by breaking down why diversification matters. Imagine you've invested all your money in one tech stock. It's been soaring. The gains look incredible, and you feel unstoppable. Then, one day, the sector takes a hit, maybe due to regulatory changes or an unexpected earnings miss, and suddenly, a huge chunk of your portfolio evaporates. That's what happens when you fail to diversify. Conversely, a well-diversified portfolio is like a symphony. If one instrument goes off key, the others keep the music going. You still get harmony, even if a few notes stumble. Diversification works because different asset classes respond differently to the same market events. Stocks might drop during a recession, but bonds or gold may rise, offsetting those losses. Commodities can act as a hedge against inflation, while real estate might generate steady income regardless of short-term market swings. Even cash and money market instruments have a role, providing liquidity and a buffer for emergencies. And for those who are comfortable with high-risk, high-reward opportunities, a small allocation in cryptocurrencies can offer growth potential while the rest of the portfolio remains stable. I want to share a story about John, a 45-year-old engineer who had been investing heavily in technology stocks for over a decade. His portfolio was heavily weighted, 80% in tech, 20% in a high-yield savings account. During bull markets, he saw impressive gains, but when the market cooled, he experienced significant losses. John realized that concentrating all his wealth in a single sector exposed him to unnecessary risk. He needed a strategy that would balance potential growth with protection against volatility. After assessing his risk tolerance and long-term goals, John implemented a diversification strategy. He reduced his tech holdings to 20% and added other equities across large-cap, mid-cap, and small-cap stocks in sectors like healthcare, consumer goods, and financials. He allocated 30% to bonds, blending government and corporate instruments for stability and predictable income. He added 10% in a real estate investment trust, providing both potential capital appreciation and rental income exposure. Commodities like gold, silver, and oil made up another 10%, hedging against inflation. The remaining 10% was cash and cash equivalents, giving him liquidity and peace of mind. The results were compelling. Over the next 5 years, John's returns weren't as spectacular as when tech stocks were surging, but they were far more stable. During downturns, the bonds and real estate acted as cushions, while commodities partially offset equity losses. John felt more confident, less stressed, and more in control. That's the beauty of diversification. It doesn't eliminate risk entirely, but it allows you to manage it intelligently. Implementing diversification isn't without challenges. It requires careful planning, monitoring, and sometimes, dealing with added complexity. You need to understand the assets you're investing in, monitor performance, and occasionally rebalance to maintain your desired allocation. Costs can also creep in, whether through transaction fees, fund management fees, or taxes. And it's possible to over-diversify, spreading yourself too thin and diluting potential gains. But with the right approach, these challenges are manageable and far outweighed by the benefits. Warren Buffett, who's no stranger to concentrated bets but also appreciates risk management, once said, "Diversification is protection against ignorance." It makes little sense if you know what you are doing. In other words, if you're new, diversification is your best ally. It buys you time, cushions shocks, and helps you stay in the game longer. Even seasoned traders use diversification strategically, blending high-confidence positions with stable, income-generating assets. From my personal experience, I've seen traders fail simply because they were overconfident in a single trade or asset class. One client I worked with was 100% invested in emerging market equities during a period of growth. Within months, political instability in the region caused the market to drop 20%. Had he diversified across bonds, domestic equities, and commodities, the loss could have been far less impactful. Diversification is like insurance, you hope you don't need it, but when things go wrong, it's invaluable. So how can you diversify effectively? Start by assessing your risk tolerance and financial goals. Decide how much risk you're comfortable taking and what you aim to achieve. Then, allocate assets across different classes: equities, fixed income, real estate, commodities, cash, and possibly a small portion in high-risk assets like crypto. Within each class, diversify further. For example, in equities, don't just buy large-cap US tech stocks, consider mid-cap, small-cap, different sectors, and even international markets. Finally, regularly review and rebalance your portfolio. Markets move, allocations drift, and your strategy needs to adapt. Here's a question for you to think about and comment on below this video. How diversified is your current portfolio, and what's one area where you think you could improve your allocation? Sharing your experience can help others learn and also give you perspective on your strategy. Diversification doesn't promise massive gains overnight, but it provides stability, reduces emotional stress, and positions you to weather market volatility while still capturing growth opportunities. It's a cornerstone of responsible investing, and for new traders, it's an absolute must. That's it for today's episode. Remember, in trading and investing, balance is everything. Spread your investments wisely, protect your capital, and approach markets with patience and discipline. Diversification is your toolkit for resilience, and over time, it can make all the difference in achieving your long-term financial goals.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading!